The Nigerian foreign exchange market recently experienced a mild depreciation of the local currency, with the Naira closing at N1370.6373 per US dollar at the official window, down from N1369.164 the previous day. This downward pressure was primarily driven by a surge in international payment obligations that outpaced the available dollar volume, alongside a reduced frequency of direct interventions by the central bank. Despite the depreciation, the official window saw a substantial 92% increase in market turnover, climbing from $65.206 million to $125.314 million. Meanwhile, a parallel positive macroeconomic indicator emerged as the nation's external reserves grew to $51.142 billion, sustained by elevated global oil prices and improved domestic crude production. Navigating the tides. Analyzing the Naira's recent shift in the official FX market. The delicate balancing act of managing Nigeria's foreign exchange landscape was on full display during the latest trading session at the official window. The Naira registered a subtle shift, sliding to an official spot rate of N1370.6373 against the US dollar. While a marginal depreciation from the previous session's close of N1369.164 might seem minor on paper, it highlights the deeper, systemic dynamics governing liquidity, international obligations, and global market pressures currently impacting the Nigerian economy. The core drivers: outflows and intervention dynamics. The primary catalyst for the Naira's recent dip stems from an imbalance between foreign exchange supply and demand. During the trading day, the currency fluctuated within a relatively tight band of N1365 to N1375 per dollar. This movement indicates that even though the local unit is showing resilience and adhering roughly to the Apex Bank's macroeconomic targets, it is facing heavy headwinds from international payment demands. When global outbound obligations surge simultaneously, they quickly consume available dollar volume within the official window. Compounding this pressure is a strategic pullback in direct central bank interventions. By allowing the market to self-regulate more organically, the authorities expose the spot rate to the raw currents of demand, causing the mild depreciation observed. Furthermore, a historically strong US dollar, fueled by global investors seeking safe haven assets amidst international uncertainty, continues to exert macro-level pressure on emerging market currencies worldwide, and the Naira is no exception. A silver lining: surging liquidity and market confidence. Despite the decline in value, the internal operational health of the official window tells a highly encouraging story. Interbank foreign exchange turnover among financial institutions and market makers witnessed an extraordinary spike. Daily volume soared by 92%, jumping from a modest $65.206 million to an impressive $125.314 million distributed across 106 distinct deals. This massive influx of transactional liquidity is crucial for several reasons. It proves that capital is moving actively through formal channels rather than migrating to unregulated parallel markets. It reflects robust transactional activity and underscores a foundational level of investor confidence in the transparency of the official window. High transaction counts indicate that institutional players are willing to clear their obligations at prevailing rates, providing a truer reflection of market value. The fiscal cushion: rising external reserves. While the immediate currency market grapples with matching supply to demand, Nigeria's broader fiscal safety net is growing stronger. Data reveals that the country's foreign reserves have climbed steadily to $51.142 billion. This accretion is directly tied to favorable conditions in the global energy sector. Sustained, elevated crude oil prices paired with a successful ramping up of domestic oil production have yielded a substantial fiscal windfall. This growing cushion offers the central bank vital leverage. Should volatility threaten to destabilize the domestic manufacturing or import sectors, these robust reserves provide the government with the necessary ammunition to inject liquidity and stabilize the local currency over the medium to long term. If you enjoy staying updated with the latest stories and trending news, please consider subscribing to TrendScope. Your support helps us bring you more content every day. Thank you. Raising hands.